what is the best way to figure out the discount rate that should be applied to an emerging market investment? Indeed, this is like the main question in emerging markets finance. How do you get that discount rate? And we studied a number of different methods. We showed the downfall of some of the methods. For example, if we looked at the country level and applied the capital asset pricing model, and we're evaluating a project of average risk in India, we know the beta for India is negative. Therefore, the expected rate of return on a project of average risk in India should be less than the US T-bill rate. And that doesn't seem to make a lot of sense. The model that we've been studying looks at the relation between country risk ratings and expected returns. And I look at a number of different ratings: institutional investors' country credit rating, Euromoney country credit rating, Moody's, S&P, the International Country Risk Guide political, financial, and economic ratings. Now look at these ratings, basically pursue the following intuition. These ratings are ex ante, are forward-looking measures of risk. Do they explain the cross-section of average returns? And when I fit a regression, looking at these returns against the lagged country ratings, the natural log of these ratings, I find a significant relation. The R-squared is in the range of 30%, which is as good as you're going to get even with the CAP-M or a multi-factor model in the US. And this includes both developed and emerging markets. So this methodology, you tell me the rating, and I can tell you what the hurdle rate should be for equity based upon that particular rating. All you need is the intercept and slope coefficient. Or you can run the International Cost of Capital and Risk Calculator program that's available through the course. Now it turns out that these ratings deliver fairly high expected rates of return, much higher than you would see from the capital asset pricing model. And the question is, how do we actually use this in project evaluation? And this is kind of my view of how we should proceed. The fundamental or base risk should be based on the industry that the project resides in. And we can figure out what industry rates of return are by really just looking at developed countries, or using some version of a capital asset pricing model that looks at industries rather than countries. So the base rate of return should be the industry return. For example, if we're building an aluminum facility in Africa, it makes sense that it should at least get the rate of return that you would get if you construct the facility in Australia. So that's kind of what we start out with, the base rate of return. The next thing is to take care of the country risk. And after that, we have to take care of project-specific risk. The country risk, what I recommend, is we run the country through the ICCRC, the International Cost of Capital and Risk Calculator program. And that is going to deliver a hurdle rate. And what we can do with that hurdle rate is either discount the cash flows by the rate that comes out of this program, or discount the cash flows by the fundamental base level for the industry and use the difference between the ICCRC hurdle rate and the base hurdle rate to make an adjustment to the cash flows. And this is actually what I recommend. So we could do all of our decision tree analysis to figure out all of the scenarios in terms of country risk. And in the end, after we assign probabilities, it's going to suggest that we reduce the expected cash flows from the optimistic scenario that nothing bad happens. The ICCRC discount rate minus the base discount rate provides another method to reduce the cash flows. And indeed, I actually recommend that it's used to calibrate the decision tree analysis or the Monte Carlo analysis if you're using many different paths. Now, the advantage of using the ICCRC is that it's consistent across all countries. The model is developed to fit many different markets with the same methodology. And certainly you can imagine a team of people looking at one country and doing a decision tree analysis. And then another team looking at another country and applying a different methodology that would not necessarily be consistent. So what we're able to do with the ICCRC is to provide consistency, to provide a way to calibrate our decision analysis. So the second stage is to reduce the cash flows by this country risk factor that comes out of the ICCRC. The third level of analysis has to do with the project-specific cash flows. And these represent things that are not necessarily linked to the country but can be affected by what happens in the country. And again, this is another way of, another factor that goes into the decision tree analysis. Now there's a final issue. It turns out that not all the cash flows have the same risk. There's a scenario where your revenues come from one source and your costs come from another source, and it could be different countries. The ICCRC method actually allows this flexibility where you can look at the ICCRC discount rates from different countries and figure out adjustment factors for the cash flows in your decision trees from many different country sources. So there is an additional level of complexity that this approach yields. Now this is in sharp contrast to the type of approach that you might hear on the street. For example, using sovereign yield spreads as an additional factor. The sovereign yield spread, we've discussed, is often, 300 basis points. It's very small compared to usually what we get out of the ICCRC. And most importantly, that model is not fit to the data. It is a model that is suggested, it is posited, but there's no evidence to support that that particular model fits the data. At least we know with the ICCRC that the ratings are weighted in such a way with a slope coefficient and an intercept that you get the best possible fit in the data. In addition, the ICCRC is based upon the foundational idea that when there's risk, it should be rewarded in terms of expected return. Now, there's some additional complexities that we have to deal with. But for a starting point, this model is highly simple, quite easily implementable, is rich in intuition. It avoids the embarrassments of suggesting a discount rate less than a T-bill rate. It provides a way to value projects and to evaluate the performance of projects.